If I had to start investing right now, with stocks pushing into fresh record territory and everybody around me acting like the easy money is back, I would be very careful about one thing above everything else. Not because record highs are automatically bad, not because the market can't keep climbing, but because this is the exact kind of moment that gets regular people to throw away a perfectly good plan and replace it with emotion. And that, in my view, is where the real damage begins. Today in New York, it is Monday, April 20th, and before we go any further, comment the day and date you're watching from, because I always like seeing where everybody's at when these market moments hit. And very quickly, if you get real value from these videos, support the channel by subscribing and drop John A.G. Best in the comments so I know you want more of this kind of breakdown. Now let's talk about what just happened, because the market did not just drift higher. It charged. The broad indexes have been tagging new highs, the tech side has been on an eye-popping run, the smaller companies have joined the party, and that matters because when the rally widens out, people start telling themselves a very dangerous story. They start saying, well, maybe this thing is bulletproof now. Maybe the hard part is over. Maybe I should wait for a dip. Maybe I already missed it. And those questions sound harmless. They're not harmless. Those are the kinds of thoughts that quietly wreck portfolios. Based on recent market action, the benchmark index has been closing at record levels. The tech-heavy index just put together its longest winning streak in decades, and small caps have been pushing to their own highs as the rally broadens beyond just the mega cap names. That kind of backdrop does something to people. When prices are falling, folks get scared. They tighten up. They second-guess everything. But when prices rip higher, they get loose. They stop respecting the system that got them here. They stop thinking in years and start thinking in afternoons. They tell themselves they're being prudent by waiting for a better entry, when a lot of the time what they're really doing is dressing fear up in a nicer outfit. And here's the kicker. The mistake most people imagine is the crash mistake. They think the big danger is panic selling at the bottom. That's one danger, sure. But another huge danger is getting so mesmerized by strength that you abandon your process right near the highs. You start trying to be clever. You stop being consistent. You become a tourist in your own financial life. One day you're a long-term investor. Next day you're staring at charts like you're going to outguess millions of participants who do this for a living. I don't say that to insult anybody. I say it because it's human nature. We all do this. We see green everywhere and our brain starts whispering, don't be the fool who buys the top. Then the market keeps going and that whisper turns into regret. Then regret turns into chasing. Then the first pullback comes. And suddenly the same person who was desperate to get in is desperate to get out. That loop right there, that's where a lot of wealth goes to die. From long-running market studies, one of the most persistent lessons is that missing just a handful of the market's best days can slash long-term returns. And many of those best days tend to show up right around the ugliest periods. That is why trying to dance in and out sounds smarter than it usually is. Because to make that work, you don't have to be right once. You have to be right twice. You have to know when to step away, and then you have to know when to come back. And the second part is where people get smoked. They wait for the headlines to feel safer. They wait for the chart to look cleaner. They wait for confirmation. By the time that comfort shows up, a lot of the move is already gone. Now, let me add a counterpoint here because I don't want to oversell the fear. A market at all-time highs is not automatically some flashing red emergency light. Markets spend more time near highs than people realize because strong businesses tend to keep growing, earnings compound, and new highs are often just what healthy bull markets do. So I'm not telling you that records mean run for the hills. I'm telling you that records are a terrible time to let your discipline melt. That distinction matters for people like us today. Because right now, a lot of people are asking the wrong question. They're asking, is this the top? I think the better question is, if this keeps running, do I still have a process? And if it drops next week, do I still have a process? If the answer changes every time the candles change color, that's not a strategy. That's mood management masquerading as investing. So what actually works better for most people? Boring works better. Systems work better. Automation works better. Showing up works better. That's why I keep coming back to steady, rules-based buying instead of this fantasy that we're all going to sidestep every downdraft and re-enter at the perfect moment. If you're investing a fixed amount on a fixed schedule, you are taking a giant chunk of ego out of the equation. You buy when things are expensive. You buy when things are ugly. You buy when the headlines are cheerful. You buy when the headlines look like they were written by a doomsday committee. And over time, that consistency does something powerful. It keeps you in the game. If you're successful, share your success story in the comments so others can stay motivated. Now, there is another layer to this story, and this is where it gets more interesting, because the market can be celebrating while the economy sends mixed signals. That's not as weird as people think. We've seen slower growth readings come through. We've also seen inflation heat back up after looking like it was cooling. And the labor market, while still standing, doesn't exactly scream unstoppable boom either. Official growth data now show the economy barely expanding at the end of last year. Consumer inflation in March running back up into the low threes year over year, energy prices up sharply from a year earlier, and unemployment sitting in the low fours with hiring no longer roaring ahead the way it once did. That mix is why you keep hearing the word stagflation float around again. Slower growth, sticky prices, softer labor conditions. None of that means we are locked into some dramatic 1970s replay. I'd be careful with that comparison. History rhymes, but it does not photocopy itself. Still, when growth cools and inflation refuses to fully behave, that creates a very awkward environment. It pressures consumers, it pressures margins, it pressures policymakers. And it can make investors increasingly sensitive to every oil spike, every jobs report, every inflation print, every central bank sentence that sounds just a little too relaxed. So why are stocks still pushing higher if the backdrop isn't clean? Because markets are forward-looking, always have been. Stocks do not simply sit there and mirror today's pain. They try to sniff out what the next few quarters might look like. If traders and investors believe inflation pressure could ease, or earnings can stay firm, or businesses can protect margins, or artificial intelligence spending can continue to support productivity and demand, they will bid up equities long before Main Street feels comfortable again. From recent earnings outlooks, profit growth for the large cap index is still projected in the low double digits for the first quarter, which would make this a long run of back-to-back strong earnings growth, and the technology sector is expected to lead again by a wide margin. That helps explain why stocks can look almost rude in the face of messy economics. The market is basically saying, yes, we see the inflation problem, yes, we see the geopolitical noise, yes, we see the softer patches in growth, but we also see companies still making money, balance sheets still holding up in a lot of places, and a giant wave of spending tied to digital infrastructure, chips, software, power demand, and productivity upgrades. Those things can coexist for a while, but that coexistence is exactly what makes moments like this tricky. Because when the tape is strong, people stop respecting risk. They start treating valuation like an old-fashioned idea. They start believing every rally deserves blind faith. And that's not true either. There are parts of this market that have earned optimism. There are also parts of this market where expectations are now doing heavy lifting. If earnings stumble, if inflation stays hotter for longer, if energy whips back up, if policy expectations shift, if geopolitical calm turns out to be temporary, then the same crowd cheering today can get very quiet, very fast. From recent market updates, oil had pulled back sharply on easing conflict fears, helping the rally. But energy prices had recently been elevated and remained a live inflation concern. So what do you do with all that? You don't panic, but you also don't float through it like none of it matters. You stay with the plan. Maybe you keep your recurring investments going exactly as scheduled. Maybe you check whether your portfolio has drifted so far into one hot area that you're no longer diversified. You're just lucky. Maybe you look at whether you own enough businesses that can defend margins when costs rise. Maybe you give a little more respect to cash flow, dividends, and balance sheet strength than you did when money felt almost free. Maybe you think about real assets, selective defensives, and whether you have enough liquidity that a surprise expense won't force you to sell good investments at a bad time. And yes, liquidity matters. Not because sitting on a mountain of cash is some master plan. It's not. Excess cash can quietly rot when inflation runs ahead of what your savings pays. But having a real emergency cushion matters because flexibility is underrated. Flexibility keeps small problems from turning into stupid decisions. If you need to pay a bill, handle a setback, or deal with life without blowing up your portfolio, that's not weakness, that's structure. And structure is what keeps investors from becoming emotional the minute the world gets noisy. I also think this is a good time to revisit what kind of investor you actually are. Not the fantasy version, the real version. Are you someone who can handle concentrated positions? Fine. Maybe you lean a little harder into them, but do it on purpose. Are you someone who loses sleep every time a holding drops a few percent? Then stop building a portfolio that depends on perfect nerves. There's no prize for pretending you're built differently than you are. And one more thing. Do not let social media convince you that everyone else has some secret map. They don't. A lot of people online only sound brilliant because you are hearing from the winners after the move already happened. Hindsight is a magician. It makes every chart look obvious after the fact. In real time, it's messy. In real time, uncertainty is the whole game. That's why I think record highs should be interpreted carefully, not fearfully, not blindly, carefully. Because the warning is not, the market touched a record, so disaster must be next. The warning is the market touched a record and now your discipline is about to be tested. That is a totally different message. If you can hold on to that, you avoid one of the most common traps in investing. You stop treating a strong market like an invitation to become impulsive. You stop acting like every gain requires a dramatic response. You stop confusing motion with progress, and you give compounding the room it needs to do its job. Wealth usually isn't built in one heroic move. It's built in repeated ordinary decisions done well for a very long time. It's built when you keep buying quality assets even when it feels boring. It's built when you rebalance before your winners become your entire personality. It's built when you admit you cannot forecast every twist, so you build a plan that does not require perfection. That, to me, is the real lesson when markets hit records. Stay awake, stay humble, stay systematic, and let the emotional people donate their returns to the market while you keep your hands steady. And if you're wondering what discipline actually looks like in a market like this, it's usually less dramatic than people want. It might mean you keep buying your broad fund every week or every paycheck and you don't touch that schedule. It might mean you trim a little from the positions that have run too far and redeploy into areas you've neglected. It might mean you stop pretending every dollar has to chase maximum upside and let part of the portfolio do the boring work of resilience. That could include businesses tied to necessities, health-related demand, infrastructure, power, or steady household spending. Not because those areas are glamorous, usually they're not. But because when growth cools a bit, the companies selling wants can wobble faster than the companies selling needs. And in an environment where inflation can flare back up without much warning, pricing power starts looking a lot more attractive than hype. That is another reason I don't love the all-or-nothing mindset. You do not need to become bearish on everything just because stocks are expensive in some places. And you do not need to become euphoric on everything just because the indexes are printing records. A mature portfolio can hold growth, cash flow, some defense, some optionality, and enough dry powder to handle life. That balance may not make for flashy screenshots, but it tends to be a lot more useful when the market stops cooperating. And remember, broad participation matters. When rallies spread beyond a handful of giant winners into transports, industrials, and smaller firms, that can be healthier than a one-note surge. But healthier does not mean risk-free. It just means the market story is wider now. Wider stories can run longer, and they can still reverse hard if the underlying assumptions change. That's exactly why process has to stay in charge. This is for education and discussion only, not personal financial advice. And before you move a dollar, make sure the plan fits your own goals, risk tolerance, and real life, because a good strategy should help you sleep at night, not just sound clever on the internet.